Okay, we're going to go ahead and get started. Welcome to Pathlight Investors' 10-minute tutorial series, where we try to focus in on a specific topic that we think is relevant and provide a quick but detailed education, hopefully in 10 minutes or less. Today's topic is the hedge fund temptation. I'm going to try and provide an insider's view of hedge funds and then ultimately answer the question, are they worth it? So to start, our mandatory disclosure, but since we're tight on time, that's enough on that. A quick background on my firm and me. Pathlight Investors is a fee-only registered investment advisor based in Phoenix, Arizona. We started the firm in 2009, and as of March of this year, we manage around $170 million in assets, and we provide direct investment management using individual equities and fixed income. So full disclosure, Pathlight is not a hedge fund, so I do have a vested interest in arguing for traditional long-only investing. But I do want the data to speak for themselves, and I want you to draw your own conclusions. As for me, my name is Adrian Larson. I am the president of Pathlight Investors. I've been in the investment arena for roughly 15 years, and I feel like I'm qualified to have this discussion because I've worked for two of the largest hedge funds out there, Andor Capital, which was a $12 billion technology-focused hedge fund, and also SAC Capital, a $15 billion diversified hedge fund run by Steve Cohen. So I have experience in this realm. A quick roadmap of what we are going to discuss. We will define what a hedge fund is. We'll talk about the exponential growth of the hedge fund industry, take a look at how hedge fund managers get ridiculously wealthy, and then we'll look at their performance record, ultimately answering that question, are they worth it, for ourselves. So what exactly is a hedge fund? It's this amorphous thing that many don't really understand, but all a hedge fund is a pooled investment vehicle structured as a limited partnership in which you have a proportional ownership of the assets. They're able to own a diverse range of investments. They can kind of go anywhere, but only accredited investors are allowed to invest. And an accredited investor is defined as an individual who has a net worth exceeding $1 million or an individual who has income over $200,000 in each of the last 2 years, what President Obama refers to affectionately as millionaires and billionaires. They also have all sorts of exotic names like long-short equity, credit, quantitative, global macro, market defensive. But really, these are just simply different strategies, much like you would find in a large, mid, or small-cap equity mutual fund. Now, the hedge fund industry has seen explosive growth in assets under management over the last 20-plus years. Now, this is a chart showing asset growth from 1990 through the third quarter of 2009. You can see the fastest growth happened between 2002 and the initial peak in 2007, growing from roughly $625 billion to over $1.8 trillion in assets under management. And that's because during this time circled here, hedge fund managers were taking advantage of the dot-com bubble and posting ridiculously good performance as all stocks were flying. I mean, the S&P 500 averaged 17.5% a year from 93 to 2000. We'd love those days to come back. But if you were in the market, you were feeling great. And as wealth grew during this time, it wanted to find a home, and that home was ultimately with hedge funds. And you see just that meteoric rise starting in 2002. Now, as a comparison, just quickly, hedge fund assets are about 10% of the size of the mutual fund industry globally. Now, as investors have poured more and more assets into hedge funds, it should come as no surprise that the number of firms looking to cash in grew exponentially as well. And this chart is the growth of the number of firms from 1990 to the third quarter of 2009. And the peak in firms happens, ironically, at the same time assets first peak in 2007. Now, keep this picture in mind for the rest of this presentation because I think it paints a pretty stark picture, and that picture is of mediocrity. Too many so-called smart people chasing too few in investment ideas. And in reality, these were the really smart people, and many of these are simply average. Now, there are two main reasons why you would start a hedge fund. The first is flexibility in investments. They can do anything like I mentioned before. The second, and more importantly to many in this industry, is money. In fact, a large hedge fund manager once told me, this is the greatest money-making business structure ever created. And it's true. So let's see why these managers make so much money. Like most investment services, hedge funds charge a percentage on assets under management, typically 2%. But the real juice comes from the performance fee that they charge. And they usually pocket 20% of the gains they have made you for that year. And this is where the term 2 and 20 comes from that you might have heard bandied about. So as a basic example, if you invested $1 million and the fund returned 10% for the year, you would pay the manager 2% on the $1 million or $20,000 and then 20% on the $100,000 gain, which was a 10% increase on your initial $1 million investment, or another $20,000. So at the end of the day, your 10% return is really only 6% after all the fees because of the $40,000 that you just paid that manager. But if you're like most investors who can't get direct access to a hedge fund, you might use what's called a fund of funds, which is simply a group that chooses a basket of hedge funds for you, in much the same way that a financial advisor at a Merrill Lynch or a Bank of America would choose a mutual fund basket. And that adds another 1% fees on assets. And then they take an additional 5% of the performance. So your 10% return that we started with is really only 4.5% after all these fees. You're giving up over 55% of your returns through fees. And I don't know how you cut it any other way, but that's just robbery. So it had better be worth it. So why would you consider a hedge fund investment if you have to pay these guys these exorbitant fees? Well, the first three are the reasons why I would hope everyone would consider an investment in a hedge fund. And those are the perception of better returns, you can gain exposure to uncorrelated assets, and you might have possible tax advantages. But the next three also attract investors, and unfortunately they do. And I call these the country club reasons, meaning you get to talk about them at your country club and impress your friends. And those are cachet, exclusivity, and what I also call the CNBC effect. And by the CNBC effect, I mean the financial media have made some of these managers into just rock stars. And people like rock stars. I mean, who doesn't want to be around a rock star? But for the remainder of the presentation here, I'm going to focus on what I believe to be the two criteria by which everyone should evaluate an investment in a hedge fund. And we'll see if they actually hold up. And those two are better returns and gaining exposure to uncorrelated assets. When you get down to it, an investment has to be worth the cost. So the question is, how have hedge funds performed? Because for the fees that they charge, and again, every single one of them charges this way, they should be able to give you more than what you can get on your own. So do they? I'm going to say they don't, and I will explain why over the next few charts. Now, this chart shows annualized performance for the two periods, 1990 to 2007 on the left, and 2008 to 2012 on the right, for the S&P 500 in red, and the Hedge Fund Research Institute Equity Hedge Index, which tracks over 2,000 long-short equity hedge funds in blue. That just means they're equity hedge funds that can own stocks and also be short stocks. Now, when looking at the HFRI Equity Hedge Index, you can see the outperformance from 1990 to 2007. 16.5% annualized returns versus 11% annualized returns, which is simply fantastic. There's no other way to put it. But since 2008, equity hedge funds have lagged the S&P 500 meaningfully and are actually posting a negative return of 0.14% per year versus a positive 3.65% per year for the S&P 500. And now that outperformance by the general equity markets is just huge. Now, let me explain why I think this dynamic exists. And this is a chart of the S&P 500 from 1980 to January of 2011, and I've labeled it with various impactful market events. From 1980 through 2008, we had very defined directional markets that were driven primarily by economic conditions, both good and bad. But starting with the financial crisis in 2008, we have been in a market that has been dominated by macro events, where every global headline causes investors to ask, is this going to be like 2008 all over again? I mean, we just had Cyprus do this again. Now, it's become very hard to make investment choices in this environment. Now, when you look at returns through the fund of funds, which adds that extra management fee that I discussed earlier, the returns are even worse. In fact, the HFRI fund of funds composite has underperformed the S&P 500 total return for the entire period, 1990 to 2012. Remember, the equity hedge index had outperformed the 1990 to 2007 time period, but the composite for the fund of funds doesn't even do that. Actually, you might remember Warren Buffett, the legendary long-term investor, made a $1 million charitable bet in 2009 with a firm called Protege Partners, and they're just a fund of funds manager, that the S&P 500 total return would outpace fund of funds over the next 10 years. And Buffett is winning this bet handily at this point. We'll see where it all plays out, but he's got a great lead so far. And 2013 hasn't started off any better for hedge funds. This chart shows the performance for the month of January, February, and also the year-to-date 2013 through the month of February for the HFRI Equity Hedge Index in blue and the S&P 500 in red. Now, we don't have March data yet, but my guess would be that the same trend is intact as the S&P has put on another roughly 3%. But the S&P has been on a tear really to start this year, and it was up 6.61% through February. Well, the hedge funds have posted a more pedestrian 3.96%. And what about fund of funds? Well, you could probably have guessed it, but they look terrible compared to the S&P 500. Only up 2.37% through February versus the 6.61% for the S&P 500. Remember those extra fees, they are a killer. Another attribute you would want when investing in a hedge fund is reduced correlation to the equity index. What that means is when markets go down, hedge funds should do better and hopefully even make you money. Now this chart shows the returns of the HFRI Equity Hedge Index in blue, the S&P 500 in red, and for illustrative purposes, Pathlight's all equity portfolio in green in 2002, which is on the left, and 2008, which is on the right, both of which were very bad years if you're a stock investor. In 2002, hedge funds could short the market and did a great job minimizing losses, down only 4.71% versus the S&P down 22.13%. And that's fantastic, a great result. Our all-equity portfolio was down 16.16%. Still better than the S&P, but remember, we can't go short the market, so it was the best that we could possibly do here. But in 2008, hedge funds did a terrible job, down 26.65% versus the S&P down 36.94%. And I say terrible because they should have done so much better than the general equity index. And because you can see Pathlight's all-equity portfolio was down even less than the hedge fund composite at only 24.01%. In theory, if you're a hedge fund, you should have blown our all-equity portfolio away. On the fund-of-funds side, which uses many asset classes, you should expect even less correlation to the general equity market because this employs credit, fixed income, arbitrage, all these quantitative, all these different strategies. And in 2002, hedge funds were again very impressive, actually posting a positive 1.02%, while the S&P was down 22.13%, which is what you would expect. Pathlight's balanced portfolio, which is made up of stocks and bonds, was down 9.01%. Now in 2008, what happened? Hedge funds of all types didn't do their job. And instead of having non-correlated assets, the HFRI fund-of-funds composite was down 21.37%, while the S&P posted a negative 36.94%. Still better than the S&P, but look at Pathlight's blended portfolio. It was actually only down 12.66%. So for hedge funds, correlations have increased as markets have become more challenging. And that's precisely the opposite of what you want to see when evaluating a hedge fund investment. So now we come to the moment where you have to ask yourself, given the performance record and the fees, are hedge funds worth it? And unfortunately or fortunately, I say yes and no. They are worth it if you can get direct access to a great manager. They are worth it if you can find a unique strategy. If that strategy really offers you truly uncorrelated assets, and if that manager has a track record of beating the general market. But they aren't worth it if you have to go through a fund of funds, because that extra layer of fees is never going to be worth it for you. They aren't worth it if it's the any fund will deal mentality, just so you can talk about investing in hedge funds. And they aren't worth it if you can't find a manager that has that track record of outperforming the general index. Now, these are the criteria by which you should judge a potential hedge fund investment, and not simply look to be involved with a hedge fund just for the sake of saying, I invest in hedge funds. So that's my time. We'll open it up to Q&A if you want to discuss anything further. My full contact information should be on your screen in case you want to contact me directly with questions. But thanks for listening. I'll go ahead and check for some questions right now. Hold on one second. I've got one question here. If a hedge fund invests in stocks, are they as liquid as stocks? Meaning, can I get my money back whenever I want? And actually, it's a very important question. Hedge funds are what we consider to be illiquid investments, even though they might invest in stocks and bonds, which typically can be turned into cash in roughly 3 days after selling something. Hedge funds have something called gates, which means when you invest with a hedge fund, you have a specific lockup time, lockup period where your money cannot be withdrawn. And you actually have to request your money be withdrawn, in most instances, 30 days at a minimum in advance, but most of the people are a quarter in advance, so 90 days. So at the end of the day, you could need some money and put a request in for it, but it's going to take 30 to 90 days before it actually shows up in your bank account. So that's a great question. Another question here. There have been many hedge fund managers that have recently been investigated or arrested for insider trading. What are the long-term impacts of this? Unfortunately, I think the industry is getting a black eye, but I do think it's going to ultimately impact performance going forward, because it makes their jobs of outperforming the general equity markets that much harder. Because hedge fund performance has been built on the ability to get better information, not necessarily illegally, but just to get better information. But I think as more practices are scrutinized and people are having to look over their shoulders and aren't totally confident that the information that they're getting is not inside information, it keeps you from acting on what could be really good info that would allow you to have some level of outsized gains as you're going forward. So I think we go back to that. It's more difficult in this environment to generate excess returns because it's become more macro impacted. But I think that also the legal issue, the legalities and the legal ramifications and the investigations are also going to hurt the hedge fund industry's ability to generate excess returns. I've got another question here. Hold on, I just got to scroll through it. Why did you decide to stop working in that field? For me, it was more of a personal choice from an investment style standpoint. The hedge funds that I was associated with were heavier into trading, meaning trying to book profits or generate profits in shorter periods of time. I'm what you would refer to as a fundamental equity analyst, meaning that I want to find good companies that I can believe in their stories for longer periods of time. Or when I was able to short stocks, I wanted to find broken companies that I didn't feel were ever going to perform, and so I could short them and make money in their decline. So it really is a personal choice and a stylistic choice. I think as well you have the mentality where it's always pushing for that next idea rather than nurturing an idea and allowing a thesis to play out over that longer period of time. So again, it's a personal choice. Although the financial rewards were fantastic in that industry, stylistically, this industry on the advisory side and long-only side fits my personality much better. So I hope that answered that question. That's all the questions that I see right now on the screen. So if you have any other questions, please don't hesitate to contact me with the contact information that's up there right now. you can check out our website, pathlightinvestors.com, where we publish a lot of our research and also our presentations. This presentation will be up on our Pathlight Interactive tab under our 10-minute tutorials section, and it will be accessible if you register for that presentation just with your name and email address. And we can also point you to the blog and our research site where we're always putting new information out. But thank you very much for attending, and we'll see you guys on the next 10-minute tutorial. Take care.